Hello, friends. This is Vijay Bhambwani, and I've been trading these markets since 1986. In this video, I want to tackle the issue about short selling. Now, short selling is in the limelight for a variety of reasons because 2 months ago, South Korea banned short sales. Around that time, the Chinese government announced that it was promoting a special purpose company to boost the stock market, to invest money in the stock market, and stop the relentless decline in Chinese share prices. So, when SEBI announced recently that it was taking steps to ban naked short sales in India, people immediately started equating those moves with South Korea. Well, I think these are two very different things because, as per the securities law in India, short sales were always banned for institutional players, especially foreign investment institutions or FIIs. Now, without really going into the dynamics of what the new regulations and rules are, because I've covered that in my weekly market outlook video, I want to tackle the issue about whether short selling actually triggers market crashes, whether a bear is an anti-social element who initiates short sales and is therefore acting against the larger interests of retail traders and society as a whole. Now, there are two ways to look at a short seller. Number one, like I said, what is being made out in social media groups, WhatsApp and Facebook and Twitter and LinkedIn groups, etc., which I happen to be a part of, and I notice the posts that people are putting up with a great degree of interest. I must admit that it's very shocking that people would actually go out and say short selling is the root cause of all evil and bear markets in the world and it should be banned. I would like to take a 360-degree worldview of the financial markets and see short selling from the point of view of a mathematical existence in the market. Now, if you're familiar with the United States of America's CFTC, Commodities Futures Trading Commission, you will know that the agency requires all traders to specify what type of transactions they are initiating at the time of initiating the transaction itself. So you have to basically tell them whether you are going long afresh, whether you're pressing short sales, and then the CFTC also categorizes traders as hedgers. These are farmers and miners and manufacturers who want to hedge against the price volatility of their finished product by taking opposing trades in the futures segment. Then you have specialists. These are speculators who have a high degree of skill in trading the markets. And then the retail guys. Retail guys are more often than not seen to take the wrong side of the direction of the market. And CFTC, in its commitment of traders reports, which comes out every week, gives you the breakup of all trades, whether they are initiated by hedgers, retails, or specialists, whether they are long, whether they are short. And believe me, people like me who believe in programming statistical trading models derive a great degree of help from the commitment of traders reports, which comes out weekly from the CFTC's website. Don't worry about how to get it. I'm providing a link in the description below this video and in the pinned comment below this video. So I want you to stop whining like an average Joe in a social media group who says short selling is evil and you basically cannot make money out of it. I beg to differ. I've been doing this where it comes to programming these statistical models and taking the CoT report from the CFTC site for many, many years. And believe me, what SEBI is doing is going along the route of CFTC and requiring traders to basically declare itself at the time of the trade, whether the trade that they are initiating is long or short, and if short, is it a fresh short or in addition to a previous short already initiated. That would help you and me to get a better understanding. You've seen some of my videos wherein I've talked about how to decipher MWPL or market wide position limits. So this a breakup of shorts will, in addition to MWPL, help us make a lot more money, get even more profitable. And I also want to discuss how short sales actually helped the market. So is short selling really bad for a bull market? Do short sellers actually cause market crashes? I'm going to discuss that here right now. Let's take a 360-degree worldview. Now, a short seller provides a counterparty. Counterparty is an opposite party to any bull. If you want to buy a stock, you need somebody to sell it to you. Now, we have moved from a public outcry system where trading used to be in the ring, where one man used to take buy and sell orders from various traders because he was known as a jobber or a market specialist. He would give you a two-way quote. For example, 500 and 505. If you wanted to sell, he would buy from you at 500. If you wanted to buy, he would sell to you at 505. The jobber provided the counterparty to the market and he provided liquidity, but his spreads were really wide. Today, we are in an order-driven electronic market where each trader basically is at a liberty to enter his limit prices, and as and when a counterparty arises, the exchange matches the trade and your transaction is initiated. If at all you were to ban short sales completely, absolutely, you would have one segment of the market out of the game and traded volumes would dry up completely. Now, do remember that the exchanges don't provide you counterparties. Those days of the jobbers are gone. The exchange is merely the facilitator that matches buyers with sellers and sellers with buyers. And as long as their prices match, the exchange merely initiates the transaction. So that's a problem number one if at all you were to ban short sales completely. Now, point number two. If at all you were to ban short selling completely, trading would become nothing less than a nightmare. The efficient market that we are seeing now is requiring a narrow bid and offer spread. Now, what is a bid and offer spread? It's the price difference between the limit prices of the buyers and sellers. Check out your screen. This is called a snap quote window. See how the buyers and sellers have entered their limit orders? The smaller is the gap or the difference between the buy and sell order limits, the narrower is the spread, which means entry and exit becomes easy if the spreads are narrow. You take home majority of the trading profit because you don't pay too much by way of a spread. Your spread is your first cost, and then comes your brokerage and other government taxes. So a ban on short sales would make the spreads much wider, as wide as your main door, and your trading profits will go for a toss. Entry and exit prices will make you scream with pain because your take-home profits will be minuscule and majority of your gains will actually be eroded by the spreads, execution costs, commission, taxes, etc. Point number three. Who buys in a falling market? A short seller, which is why a short seller provides liquidity in a falling market. An average retail trader might get tired of averaging his previous purchases, or he might even run out of funds at some point in time. If short selling was banned and buyers got tired or ran out of money, in that case, volumes would dry up and bid and offer spreads would get even more wider than they actually are. On the other hand, a short seller is an actively interested party in buying on declines because he has pressed short sales at higher levels, and by purchases, he is actually booking profits on declines. That keeps the bid and offer spreads small, and even after a sizable fall in prices, there are active buyers across the board because a short seller yesterday is a buyer today. Now, even if you were a deep pocketed investor who has unlimited supply of money, which I don't see how it could happen, but let's say you do, would you buy after a big fall if the bid and offer spread was, say, 5%? I doubt it. Nowadays, the bid and offer spreads are as small as 3 to 5 tick prices. One tick is equal to 5 paise. So where you're paying 20 to 25, maybe 30 paise difference in buy and sell spreads, if the bid and offer spread was to go to 5%, you would run the other way. I would. Point number 4. Short selling actually strengthens a bull market. I can hear many a newbie trader saying, "What? Have you wigged out? Have you lost your head?" But let me assure you, this is a mathematical postulate. A postulate is a statement that needs no verification, like the sun is out in the daytime. It is dark at night. You don't need to verify it. You know it's true. So that's a postulate. Short selling strengthens the market is also a postulate. You see, when there are shorts built into trading positions, short sellers are also likely to keep stop losses. When bulls have an upper hand and manage to push prices higher, short sellers have to run for cover and close their shorts. So their short squeeze or forced buying triggers even higher prices. There are times when short covering is known to cause dual pressure phenomena. This occurs when buyers and sellers are both buying due to their various reasons. A buyer is buying out of habit and a seller is buying because he's covering his shorts either at a profit or at a deep loss. Now, this collective buying has a double impact on prices and can even cause upper circuits. This is known as dual pressure. I have actually recorded a video on dual pressure and how to know whether a stock can hit an upper circuit. The hyperlink to that video is in the description below this video and in the pinned comment below.
It's not that regulators in the financial markets world over have not tried banning short sales in the past. Whether it is after 9/11 or whether it is the global financial crisis, regulators have tried to interfere with the market by putting restrictions or outright bans across the board on short sales. But history has proved to us that when you take away one side of the market, which is the seller's side of the market becomes weak, lopsided, and is vulnerable to a crash at a later date. So, empirical evidence seems to suggest that outright ban of short sales is actually counterproductive to the market's good health. So, are short sellers actually misunderstood evangelists or sages who are all pure and don't resort to any deliberate bearish attacks on the market? No, I'm not saying that. Short sellers are known to have triggered market price declines, even some amount of crashes. But do remember that a short seller today would have to come back to buy tomorrow at lower levels. So a short seller can only have impact on the market for that particular a period of time when he's active. At a later date, he would have to come and buy his shorts to book profits. So it works both ways. A short seller provides liquidity, he's a future buyer, and he can also impact prices negatively, just as a bull can push prices higher with his buying. It's a part and parcel of a two-way market.
Knowing that short covering can actually trigger upper circuits, do you really want to ban short selling and initiate a blanket ban across the board and say, okay, tomorrow morning onwards, no more short sales? Think about it. The market is not exactly as it seems on the surface. The concept of WYSIWYG, what you see is what you get, does not exist in the markets. There is more to it than that meets the eye. You need to break away from the rank and file newbie who doesn't know any better and screams without even thinking, if you ban short sales, the market will move up. The market is about a democratic process of buying and selling. It's a two-way process because each guy is a counterparty to the other. By immediately banning one side of the market, you make the market lopsided, and once short sales are banned and markets run up, the bulls have bought all that they want, they have nobody to sell it to, the markets would collapse like a house of cards. Which is why two sides of the market needs to function, and SEBI knows that. It's done the right thing by saying we are going to allow you to short sell in the futures and option space. We are even going to allow you to short sell in the delivery segment, but you will have to resort to borrowing shares from the SLB, or stock lending and borrowing mechanism that we've put in place. Just go about it in a very organized manner. Now that you've understood the entire mechanics of short sales, and you also know that short selling does not necessarily create bear markets, what do you think about this video? I would love to hear from you in the comment segment. Also, I would request you to subscribe to my YouTube channel if you haven't already done so. Share my video with your family and friends and social media groups to get the message across. Enlighten traders who don't know what short selling is all about. Click on the bell icon to receive instant alerts about fresh videos being put up out here. I thank you for your patience in being with me in this video till we meet again in my next. This is Vijay Bhambwani signing off for now. Take care. Bye-bye.